Welcome to Opening Bid. I'm Yahoo Finance Executive Editor Brian Sozzi. Like I always say, this is a podcast that will make you a better investor and, yes, a better leader. Before we get to our featured guest for today, I have to start off with a stock of the day. Returning favorite for Opening Bid fans out there, that is Nvidia. You're seeing markets being absolutely eviscerated on news from a company most people have never even heard of. It's not deepfake, it's DeepSeek. DeepSeek, company out of China, really touting its latest AI model. And the fears are this company reportedly, of course, you always have to question a lot of news coming out of China, reportedly has created a model more powerful than OpenAI and Meta's Llama model using less chips or less high-powered chips. So the fears on the street is that a lot of this AI spending will be dialed back. That will, of course, impact or potentially impact the likes of Nvidia. I would just caution folks like this. You're seeing Nvidia potentially heading toward its worst day ever in terms of losing market cap. Stock's down about 10% pre-market as you're listening to this. It's not like Meta and a lot of these other companies going to change their capital expenditure plans today because of some company many don't even know. So you have to question news like this. And that's why you could probably end up seeing investors come into Nvidia after this very steep sell-off, because the next 4 quarters for Nvidia, by all indications, are going to be absolutely mind-blowing. Now, where it could impact Nvidia and a lot of their chip players is the outlook for 2026. Does AI spending continue to ramp in 2026 if companies are able to use less computing power or use less chips to create even more high power models? Something to watch there moving forward. I want to stay on this thread with our next guest here. Jason Thomas, Head of Global Research, Investment Strategy at Carlyle. Jason, good to see you. Your note and your research, very well timed because you dig into a lot of this. So I'll put this question to you. Should investors fear the news coming out of a DeepSeek?
I think that it's a shock, of course. And it's not just a market development. When we look at the U.S. economy over the last 2 years, and it's really remarkable resilience and strength in the face of high interest rates, it's mostly attributable to this boom in what you could call fixed industrial investment. Some of that, of course, is manufacturing reshoring. A lot of it is EVs, battery factories. But of course, we all know the biggest driver is AI spend. You have 4 companies, just 4 companies, and these are, of course, some of NVIDIA's biggest customers, that are intending to increase their capital budgets by 90% in 2025 relative to 2023. So you have just 4 companies combining to spend almost $300 billion this year. And again, this is now really significant from a macro perspective. These companies' capital budgets have gone, as a share of GDP, it's risen 6-fold in the past several years. So again, this is not just about markets or about individual stocks. It has very significant macro significance. And the premise of this spending, number one, is that you need all these capital outlays to achieve your AI goals. And secondly, that this capital spending is going to be highly productive in that it's going to lead to applications, revenues, all these downstream use cases that are going to generate more than sufficient revenues to generate significant returns on all this incremental capital. And so this news, again, it's preliminary. I don't think it's, it doesn't make sense to overreact to it, but it does raise questions about whether, again, all this spending is necessary. And then secondly, whether the return on all that capital, if it's not, is going to meet investor expectations and essentially validate the very high valuations of many of these businesses that have been spending to such a large extent.
And listeners, in Opening Bid, I should note, I'm going to share Jason's chart on my X account at Brian Sozzi, and also LinkedIn at Brian Sozzi as well, because I think it really is interesting stuff. Jason, but do you think, you mentioned this was a shock. Do you think it's a warranted shock that investors need to get realistic with some of their expectations on future growth?
Yes, I think that, a lot of people, when they focus on NVIDIA stock, they focus on in the 10Q disclosures, they demonstrate this concentration risk. That I think in the 2 quarters ago, it was 4 customers that accounted for 48% of revenues. The most recent quarterly filing, I think it was 3, accounting for 36%. So again, this sense of concentration risk is something that a lot of analysts have pointed out. But this is also, again, of course, a question of concentration risk for stock market investors more broadly. When you have, this handful of companies, 5 or 6, accounting for about 28% of total U.S. stock market capitalization. But again, what I'm also suggesting, and the reason that I'm more concerned, is because of the macro significance that you have a relatively small share of the economy that is accounting for an outsized share of the growth in GDP, again, because of how much they've been investing. So, this is an economy that's performed well, but I think we've seen in recent weeks, recent months, the compression of risk premia. And that's where I think we'll probably see now some widening, some just the discount rates applied to these future cash flows, applied to this growth expectations that actually increase somewhat, just to get better compensated for the unknowns here. And the unknowns, I think, is again the potential for alternatives to some of the approaches that have taken with the generative and foundational AI models that could actually be much more efficient, that actually do not involve the same demand for compute and capacity. So again, we'll see, but to me, this is mostly about the price of risk and getting better compensated for what we don't know as far as what lies ahead with AI.
Well, Jason, you're a researcher. Then is the investment thesis for Nvidia, the longer term investment thesis for Nvidia, because of this one piece of news, do you need to toss that in the trash? 2 weeks ago, everybody loved Nvidia. They're going to grow X by X amount. They're valued at 35 times forward earnings. Their earnings are going to grow double digits for the foreseeable future. But do you just need to just take it, throw it in the garbage, and totally rewrite how the company or how one thinks the company is going to grow?
No. Again, this is, you can make your projections and you can have your best estimates about what's going to happen on the top line. The maintenance of these very wide margins. You can make your assumptions there about competition. And you should, again, I don't know how much things have changed on that front. But then you have the question of the valuation. And again, this is an issue of what is the expected return here, and how much are you getting compensated for the risk that your estimates, however well constructed and conceived, don't actually turn out to be the case. And that's where I think, just again, a rethinking of the price of some of these assets, not because you're fundamentally rewriting your forecasts, but just because you want a bit more compensation for, just the error bands, the range of potential outcomes.
Isn't it good that investors are being taught this lesson? Don't they need to be reminded sometimes, Jason, that stocks don't always go up in a straight line? I mean, sometimes these things happen, and it's healthy.
Absolutely, it's healthy, and that's how the expected returns increase, right? So the price falls today, valuations come down, and then the expected return, if those forecasts come to fruition, it is actually higher as a consequence. So I think that's very important. When you have a company that is growing as rapidly, with expectations for earnings growth in that high as far as the eye can see, and it's priced to a return of maybe 7 to 10%, that there's a lot of risk there. And so I think, again, that this increased compensation for risk is very healthy, and eventually will draw more buyers in, of course.
The other side of this, Jason, of course, you spent time in government, is that you see a project like Stargate. I mean, is this just going to be a major cash grab for the likes of Nvidia and any one other company remotely doing something in AI?
Yeah, I think that, again, this is the contribution to the economy, again, cannot be overstated. And this is also, again, when people think about real interest rates, and you think of, we've been so focused on inflation. When inflation comes down, the Fed can cut aggressively, we can get rates back down below 3%. But that I think looks past the underlying demand for capital, and also, of course, the amount of savings that is being consumed by federal deficits. But we have today an economy that is just fundamentally different from the one that existed prior to the onset of the pandemic. During that period of time, there was talk of secular stagnation. Mm-hmm. There was not the underlying demand for capital. These companies today Nvidia's customers that are spending so much money, and now, of course, other consortiums that have to spend so much money to try to compete with them, we're actually, just generating cash and distributing it to their shareholders.
The good old days, we call that, Jason. The good old days.
That's
now
right.
you have Meta dumping $65 billion on AI projects. I mean, to your point, I mean, maybe they would have did a special dividend 10 years ago.
No, exactly.
5 years ago.
So when you look at the cumulative savings of the corporate sector, essentially free cash flow. How much of your operating cash flow are you reinvesting in the business? That's down on a cumulative basis this cycle relative to last by 75%. So this gets into a lot more demand for capital, a lot less savings. You have real interest rates today, 2%, slightly below, but it feels to me that that's what we used to think of as normal prior to 2008. And again, if you have this continued spending, with Stargate and again, just a sense that this is the only way to compete in this market, you would have to presume that interest rates at those levels are likely to persist.
All right, Jason, hang with us. We're going to go off for a quick break. We'll be right back on Opening Bid. All right, having a great chat here with Jason Thomas, Head of Global Research Investment Strategy at Carlyle. I love what you're saying here, Jason. Really, I would say it's a breath of fresh air to the Nvidia bulls. I think they've begun they've only expected gains. Let's put it that way. But let's change gears here a little bit because we're also coming up against a Federal Reserve week. We could see the Federal Reserve stand pat again on interest rates. We have an unknown outlook for tariffs. And I think what you brought up on concentration risk in these markets is very important because the reality is, and I'd love to get your take on this, the back half of the year for rates, for tariffs, it's really uncertain. It just feels like stocks should be trading at lower valuations.
Yeah, I think that's right. That it's a sense of, again, an economy that's performing well, high expectations, I think in many cases that are warranted, but when you look at risk premia, and again, if you look at credit spreads, if you look at implied equity risk premia based on these valuations, you're getting a sense that everything has to go according to plan, just to almost break even in some sense.
And it never goes. It never goes according to plan. Never goes.
And so I think the encouraging first week, aside from the dust up with Columbia in Sunday, and what an eventful Sunday it was in Washington in the news flow, there wasn't a announcement of blanket tariffs. We're still trying to understand, I think, what is the purpose of tariffs? And the reason I say that is because they can serve many different functions. You can have it as a source of revenue, of course, maybe offset some of the revenue lost if you were to extend the expiring provisions of the 2017 tax cuts, which is, of course, a goal of the White House. Secondly, of course, tariffs can be used to facilitate domestic investment, reindustrialization. As you saw it at Davos and in the video stream, the president suggesting that you're going to get tariffed unless you invest in the United States. So it's a threat to try to, again, boost domestic investment. And then, of course, it's also a bargaining chip. It's a way to, essentially shape the policies of foreign governments. But each of these purposes, each of these uses, it is in some ways contradictory to the other. For example, if you want tariffs to be a source of revenue, you need imports because that's your new tax base. And if instead you're getting reindustrialization or investment in the United States so that more demand of the United States is met through domestic production, of course, your imports are going to fall. There's going to be less revenue generated. Similarly, if you're just using tariffs as a bargaining chip, you apply them or threaten them until the policies change. Well, once those policies change, you're not getting reindustrialization because obviously management teams, businesses cannot make investments on the basis of tariffs that may only be in place for 3 weeks or, as we saw yesterday, threatened for the, better part of 3 or 4 hours. So again, I think this question about tariffs and how they come in, there's the threshold question of what is trying to be accomplished and how would a success be defined. And I think we're going to learn that over the course of this year.
You bring up a good point. When I was on the ground job, I was talking to a lot of CEOs that are uplifting their supply chains out of China. And I'm thinking to myself, Jason, wow, this is adding a lot of costs, a lot of complexity to do this. How do you, any company that's exposed to tariffs, do you buy those stocks? These are just, it just seemed like a lot of moving parts to me. And obviously, I'm not buying and selling stocks. It's not what I do here, just trying to report on companies and these leaders. But it just seems like there's a lot more costs that are going to be going in the system. Margins are going to take a hit. And maybe it's a good time to raise some cash and just not be in stocks at all.
Well, I would say that what we're learning also, and this is, of course, the case since the onset of the pandemic, is that there's going to be less ability to generate cost reductions through the processes of unbundling and outsourcing. And so that means that to hit profit growth, management teams are going to have to rely on price to a much larger extent than they had in the prior decade. And I think it was really interesting when you had the supply chain crisis, when you had the initial outbreak of inflation, there were a lot of management teams that didn't even know you could raise prices. They'd spent 20 years, in their jobs and had never even thought about raising prices because of, just a sense that any price increase would be self-defeating, you'd lose market share. So the focus had always been on reducing costs.
Yeah, why raise prices on consumers when you could just do like Jack Welch, yank and rank? You just hit a button, you fire people. I mean, a lot easier, right?
Well, but again, I think that it's you went from the way I think about things is you started from a model of like a Ford Motor Company in the 1920s, where you have basically a factory that is the entire production process. Raw materials come in, a car leaves. And then you get to the other end of the continuum, like an Apple as of a decade ago, where you have every component, every part, every part of the production process, the software design, the development is all occurring at different facilities all over the world. 35 different facilities that are all working on a specific part of the production process. And so this unbundling, taking a individual factory and essentially turning it into this very long supply chain where each link is its own individual contestable market, that was a big driver of the decline in consumer prices for durable goods. And I think that we're at the start of a period where that is, those cost reductions through that sort of approach, it is just no longer tenable. And so I think that it's not just that the tariffs in terms people very, very focused on the inflationary impact from the direct application of the tariffs. But I think that the bigger source of potential inflation is just this recognition among management teams that when there are those temporary supply disruptions, that they have to take advantage of them through more aggressive pricing, algorithmic pricing, where you can price discriminate. I just think this lever of price, which had not been pulled, again, for the better part of 20 years, is now something that is actually much more in the mix in terms of hitting profit growth targets. And so I think it's something that's important to consider looking at pricing power. So it's not just, this company is exposed to China, or it's exposed, to the supply chain risk and the risk of tariffs. It's thinking, well, what do they make? Do they have sufficient pricing power? Can they actually make up for the fact that some of these cost reductions may not materialize going forward?
I want to go back to what you said at the top of the show about concentration risk. If these big, giant stocks, Nvidia, Apple, Microsoft, Meta, the Mag 7, as a lot of people know, if they're not going to work right now, what's your biggest fears about the broader stock market?
Well, it is. I mean, when you think about, you've never had a 5 to 7 stocks that accounted for a larger share, not only of U.S. stock market capitalization, but global stock market capitalization. So, it's about 12% of the global stock market that is, in this small handful of companies. So, I think that the indexes, just ETFs, there is obviously quite a lot of risk there unless these AI investments pan out and go, almost exactly according to plan. But I think that also means that you have now it's more attractive to have stock picking. Also, of course, more active management in private equity and private investment management. And you also just other indexes, small cap stocks, value, these sorts of factors or exposures that hadn't performed very well for a long time, as most of the gains have been concentrated in these very large, in many cases, very fast growing businesses, that these valuations do not look all that high. And I think that there is ways for investors to generate very attractive returns, just not using the playbook, perhaps, that worked so well over the past few years.
Jason, in the last 2 minutes of the opening bid, we always love to ask guests for their hot takes. My question to you is this: what is your favorite company to research and why?
Well, it's boring for my answer, but Nvidia's conference calls, the quarterly reports, and then of course their customers, they went from something that was of interest to stock investors to actually of great interest to macroeconomists. Again, precisely because once you have, a handful of companies that are accounting for almost 1% of GDP just on their capital budgets, leaving aside, all their revenues and of course payrolls, well, suddenly you have to pay quite a lot of attention to it. And that is, I think, where most of the action was, and I think it will be, on a go-forward basis. Now you have DeepSeek, that this is going to be, of course, a topic of conversation on every analyst call. How are people going to respond to it? You had for the much of 2024, there were when CEOs were asked about all this spending, where are the revenues? Where are the applications? How can you justify all the spending? It was basically very much a trust us. We think the risk of underinvestment is much greater than the risk of overinvestment here. I think it got more concrete as the year went on. There's a sense of maybe disintermediating much of the enterprise software, where you'd have AI agents they're actually doing the basic business logic and interfacing with databases.
As a former stock analyst, I love that answer, and I'm awarding it my top hot take of the month for January. Love that. Jason Thomas, Head of Global Research, Investment Strategy at Carlyle. Good to see you. Look forward to staying in touch.
Thank you.
All right, that's it for the latest episode of Opening Bid. Hit us with those thumbs up on all major podcast platforms. Stars. Appreciate all the engagement. We'll talk to you soon.